Hello, going to talk a little bit today about stock transactions and stock financing. Go ahead and pull up the file. Okay, so basically a couple of things here. Talk a little bit about the corporate form of business, which basically a corporation would be you would file, you incorporate within a state, you would have stockholders, and it does offer some advantages in that probably the biggest one would be limited liability, which means that investors in a corporation can only lose their investment. They can't be held for anything liable above that. Probably the biggest disadvantage, disadvantage would be probably double taxation, in that the earnings are taxed at the corporate level, and then they are also then taxed at the personal level after they're passed along to the stockholders as dividends. Now, probably another one would be that corporations tend to have to deal with more government red tape, more government more government litigation, more government, filing, reporting, all of that. They tend to have to deal a lot more with that too. That would probably be the other disadvantage. Stockholders are the owners of a corporation. If you own one share of stock in a company, you are a part owner of that corporation. Now, there's something called preemptive right, which stockholders have. And what that means is that if you own a certain percentage of the stock of that company, if they issue new shares, you would have the right to buy that percentage of those new shares that they're issuing in order to keep your percentage of ownership intact. So if I own 10% of Ford Motor Company and they decided to reissue some more shares or reissue new shares, then I would have the ability to buy up to 10% of that new issuance to keep my ownership percentage in place. I could purchase them or I could decide not to, but it would be my choice. Now, a couple of other terms. You got authorized stock, which is when the beginning, when a company is incorporating, they set up how many shares are they authorized to issue. And typically they set up for a lot of shares, a pretty big number. In that what they're trying to do is they are trying to basically get set up to for a lot of shares. So kind of think of it this way. Here's a good way to think about it. In that when a company gets set up, when a corporation gets set up, they want to go ahead and set up to get themselves in their initial charter set up to issue a lot of shares. Because if they go above that, then they'd have to come back and revisit and redo their charter. Where if they go ahead and set it up for a bunch of shares in the beginning, they don't have to come back when they just want to issue more. So that's a tendency. Like, what if a company thought, well, probably, we're going to issue a couple 100,000 to start, but they go ahead and set it up for 5 million shares. It's well beyond what they're starting with, and probably a number that they wouldn't reach for years to come, but they go ahead and set it up that way. So authorized stock is the number of shares that a company is authorized to issue. Now, issued stock, this is basically what's been issued to the public. So this would be what the public has purchased. One thing to think about stock is a company is selling ownership for cash. They are selling ownership for cash. Then the company gets that cash back, and then they can use it to invest in their business. Now, the market value of stock would be what it's selling for on an exchange, the New York Stock Exchange, for example. That would be the market value of the stock. Now, let's look at some of the entries related to issuing stock under different circumstances. So one would be issuing par value stock. And so let's say we have 1,000 shares, par value is $1 per share, and the issue price is $10 per share. Now, what par value used to be is kind of a minimum legal capital. And what that means is it used to represent, in many states, a required minimum capital that basically shareholders were responsible for. Now, it's kind of gone away from that meaning today. And par is more kind of a set value given by the corporation in relation to their stock. So if a company were to issue this 1,000 shares with $1 par value and a $10 issue price, so they issue it to the public buys it, company gets the cash. The journal entry the company would do to record that is they would debit cash, they would credit paid in capital in excess of par for 9, and they would credit common stock for 1. Now, here's something to think about here. The total cash that the company is receiving is going to be the number of shares times the market price. The credit to common stock is going to be the number of shares times the par value, which again here is 1,000. The difference between what they issue it for and the par value is known as paid in capital in excess of par. It's the difference between what they receive and the par value of the stock. Okay, now what this would look like on the balance sheet would be on the balance sheet, you'd have under stockholders' equity, you'd have common stock, $1 par value, 10,000 shares authorized, 1,000 shares issued and outstanding. That would be for 1,000. And then you'd have paid in capital in excess of par common stock for 9,000. So after this transaction here, this is basically what it would look like on the balance sheet in relation to that. Now, issuing no par common value, no par value common stock. So let's say we have 1,000 shares, issue price is $10 a share. If there's no par value common stock, which companies do have the ability to issue no par value common stock, then you would just debit cash. The company would debit cash for what they received, and they would credit common stock then for the full value that they issued it for, whatever price they issued it for. If there's no par value, this would basically be the way you would want to handle it. Now, what about issuing stated value stock? If we had 1,000 shares, we had a stated value of $1 per share, and we had an issue price of $10 per share. The stated value, well, let me just say this, the stated value is treated just like par value. It's just kind of a set value that the company gives their shares. And so what the company would do here is they would debit cash for, again, the number of shares times the issue price. They would credit common stock for the number of shares times the stated value. And then what's the difference between the cash they received and the stated value would be paid in capital in excess of stated value common stock. That would be the journal entry here. Now, issuing stock for non-cash assets. Issuing stock for non-cash assets. Basically, we would have, in this case, let's say 10,000 shares, $1 par value, and we're going to trade these for a building with a fair value of $150,000. So basically what we would do here is we would debit building for its value or the price. This would be the price of the building right here, $150,000. Because we're receiving the asset. And instead of issuing the stock for cash, we're issuing this for an asset. So we're receiving the asset. So we would debit here building for $150,000. We would credit common stock for 10. That would basically be the number of shares times the par value. And the difference between the two here would be a credit to paid in capital in excess of par common stock. That would be for $140,000 here. So the difference between between what you pay for the asset and the par value of the stock, paid in capital in excess of par, would be recorded for the difference between the two. In this case, it's just instead of receiving cash for the stock, we're receiving some type of an asset. Usually, whenever stock is traded, it's for a larger dollar value piece of equipment, such as equipment or larger dollar value asset, piece of equipment, a land or a building or something of that nature, something pretty large typically. So those are some transactions related to stock. Now let's look at cash dividends here. Now, of course, dividends are whenever a company rewards their shareholders by sharing some of their profits with those shareholders. And so when it comes to cash dividends, there are some journal entries that would be made here. Now, the date of declaration is the date that the board of directors declares the dividend. And when the board of directors declares it, the company must recognize a journal entry just like this, and then those dividends become a liability or an obligation of the corporation. So at the date of declaration, the company would debit retained earnings, and they would credit common dividend payable for the amount of the dividends. So the date of record is typically about a month after the date of declaration, and the date of record is simply all stockholders as of this date will receive the dividend. Now, there would be no journal entry for the date of record, but it would be noted in the notes to the financial statements that kind of when the dividend was declared, when the date of record was, and when the payment was made. So no journal entry, but the date of record is important because it's the date that all stockholders of record at that date will receive the dividend. Now, the date of payment, this would be the date that the checks go out to the stockholders. And so notice that we're going to clear out that common dividend payable. We're going to debit common dividend payable for $10,000 because remember we credited it here when we first recognized or established or approved the dividend, the board of directors did. And then we would credit cash, and then this would be the amount of cash actually paid out to the stockholders. Now, stock dividends. Stock dividends are something that on occasion a company will pay out additional shares of stock instead of paying out cash. A lot of companies tend to do this whenever they're short on cash, whenever maybe the economy has taken a downturn and they still want to give their stockholders something, but they're running low on cash, so they don't want to give out cash. So they do a stock dividend. So in the case of, say, a small stock dividend, which is like 10%, basically what would happen here is, let's say we had 10,000 outstanding shares. Par value is $1 per share. Market price is 15. So let's say our outstanding shares are 10,000. So let's say we're doing a 10% stock dividend. So 10% of 10,000, that means we're going to give out 1,000 shares. So what the journal entry to record this dividend would look like is you would basically debit retained earnings for 15,000. That would be the 1,000 shares being given out times the current market price of $15 a share. We would credit common stock dividend distributable for 1,000, which would be the number of shares given out times the par value, and the difference between what the market value and the par value would be, in this case, paid in capital in excess of par common stock. Now, at the payment date, this would be kind of at the declaration date right here. You would do this of a stock dividend. And then when the stock dividend is actually paid, you would just debit that common stock dividend distributable to clear it out, and you would credit common stock. So this would be the journal entry that would, this would how you would record a small stock dividend, which dividends are normally small stock dividends. Now, a stock split also might occur. And what a stock split is, this is when a company decides maybe that their stock is more marketable at a lower price, so they give out more shares. And whenever more shares go out in the marketplace, it floods the market and it lowers the stock price. So for example, Walmart used to do this a lot back in the 80s and the 90s. And what they would do is whenever their stock would hit about $50 a share, they would do a 2-for-1 stock split, and it would reduce the price to about $25 a share. But all the stockholders now had more shares. So think about it this way. If I own 100 shares of Walmart at $50 a share, then the value of my investment is what, $5,000. So Walmart does a 2-for-1 stock split. So now I own 200 shares, but the value of my investment has dropped to $25. It's dropped in half because there are twice the number of shares out there. And so now I would have 200 shares at $25 a share. The value of my investment would still be $5,000. So a stock split basically puts more share gives more shares to the stockholders, lowers the price of the stock. So the value of the stockholders' investment remains about the same. But again, some companies just feel like their stock is more marketable at the lower values. Some examples of this recently are Apple did a 4-for-1 stock split a couple of years ago. And think about a year ago, Tesla did like a 4 or 5-for-1 stock split. So they do still happen. They don't happen as often as they used to, like back in the 80s and the 90s, when Walmart and Microsoft were really growing. They would split their stock regularly. Doesn't happen as often as that, but it still does happen sometimes. And I know two big cases when the last couple of years have been Apple and went right off the top of my head. Apple and the electric car company, the very famous electric car company that is worth a lot of money today. They did that also as well. They did a 4-for-1, 5-for-1 stock split. Okay. Can't believe it just went right off the top of my mind. So anyway, so retained earnings, the next area. I'll remember it in a moment and I'll say something about it. I think I'd mentioned it right before, so I'd mentioned it a moment ago. So retained earnings. Remember retained earnings, this was looked at it in kind of in financial accounting, kind of an early chapter. Chapters 1, 2, 3 kind of mentioned in there. But basically retained earnings are the earnings that a company reinvests back in the business. And the formula for it basically would be your beginning balance plus net income minus dividends gives you your ending balance. And it builds up over time and keeps building up as companies invest more and more back into their business. Now, what I wanted to mention here in relation to retained earnings was something here called prior period adjustments. And what a prior period adjustment is, what a prior period adjustment here is whenever something is found like an error in a previous year, then basically that it would affect net income materially. What happens is you would basically do a prior period adjustment. So you would have like balance on January 1st. Then you would add or subtract the amount of the prior period adjustment, whether that mistake from an earlier period would increase or decrease current income or decrease the balance in retained earnings. And then basically you would come up with like the new balance or balance after the prior period adjustment. And then that would be what you would add net income and work forward to. So this doesn't happen very often, but on occasion, an error might be missed on a prior year. And that error would positively or negatively affect net income. Net income, as you see, is closed into retained earnings. So the best way to do that is to go back and redo or change your beginning balance of retained earnings as if that mistake had not been made and things had been correct all along. That's what the prior period adjustment is. And it's just an adjustment to that beginning balance from an error from a previous year. Could be 1, 2, 3 years back, actually. Okay. So let's talk a little bit about preferred stock. What preferred stock is preferred stock is basically, well, let's take one step back here. The types of stock that we looked at earlier was common stock. So up to this point, all we've looked at is common stock. Every corporation has common stock. Common stock is the main stock that's issued to raise funds for the company. Now, preferred stock. Preferred stock is only some companies issue it. And preferred stock is basically kind of almost a hybrid between stock and debt. So what preferred stock is preferred stock would be whenever a company wants to raise money, they don't want to dilute their pool and issue more common shares. And maybe they don't want to issue debt because maybe they or just feel like they've issued enough debt. So they do preferred stock. Now, preferred stock gives basically the preferred stockholders preference when it comes to the payment of dividends and in liquidation. So if the corporation were to liquidate, preferred stockholders would get their money first before common. And also, any dividends that are paid, preferred has to get theirs before common stockholders can get anything. So preferred stock does have its place in that, like I said, anytime a company issues common shares, it puts more shares out there and tends to lower their stock price. So sometimes that will anger their current stockholders. But if they issue preferred stock, it does not affect the common stock price. And so, and also, it's kind of like I said, a hybrid between stock and debt. So it does not affect debt. Also, is not accounted for as debt that the company would owe. So some companies like it. Now, less than 20% of all corporations do preferred stock. So not all do, but a few do use it. Probably the biggest downside to preferred stock is it's very expensive. It's more expensive than common stock, and it's more expensive than debt. And so probably its biggest downside is it is an expensive alternative because it does pay dividends and guaranteed or larger dividends than common, and dividends are not tax deductible. So it tends to be a pretty expensive way to finance growth, but it is an option for some companies that they feel like it might be the best option for them. Now, let's say we were going to issue 1,000 shares. The par values tend to be higher for preferred stock. So let's say the par value is 10, the issue price is 12. Typically for preferred stock, the issue price is typically not much above the par value. Typically just a little bit above it, but not much. Tesla is the name of the car company from earlier. Anyway, I knew it'd come back to me. But I think I'd mentioned it right before that did the stock split recently. So anyway, had to throw that in there. Couldn't resist. So how would this journal entry be made? The company would debit cash for 12,000. That would be the number of shares, 1,000 times the issue price. They would credit preferred stock for the number of shares times the par value, 1,000 times 10. And the difference between what they receive and the value, the par value, would again be paid in capital in excess of par, in this case, preferred stock. That's the difference. So again, preferred stock is a way for companies to raise money, to bring in money, to invest back in the business, to build up their business. Now, one thing I did want to talk about here is dividends and preferred stock. Remember I said that preferred stock has preference when it comes to dividends? Well, there's two types of preferred stock. You've got cumulative and non-cumulative. Now, cumulative preferred stock would mean that in any year that preferred does not get their fully allotted dividend, it goes into an account called dividends in arrears, and all dividends in arrears and current dividends have to be paid before common can get anything. Now, non-cumulative preferred stock would be stock that only receives preference in the current year, that nothing would be transferred forward in relation to preference of dividends. Now, participating would mean that this would be preferred stock that once preferred got theirs, once common got theirs, they would participate in splitting up whatever's left with common. And non-participating would mean that that preferred stock got theirs and then common got all the rest. Preferred would not get anything above what they were due to get. Everything else would go to common. So let's look at an example of this. Let's say we have preferred stock. We've got 10,000 shares. The par value is $50 a share, and the dividends are going to be 10%. Sometimes you're going to see dividends given to you like this. Sometimes they're just going to give you a dollar figure like per share. Sometimes they're going to say a percentage. Now, if they give you a percentage, that is a percentage of the par value. So in this case, I'm going to say this preferred stock is cumulative and it's non-participating. And the preferred annual dividend, since it's 10%, I would take 10% of the par value. So it's going to be $5 a share. You take that times the 10,000 shares, and it's going to be $50,000 per year. So this is the amount of dividends that are due these preferred stockholders every year. So let's look at kind of how this would be handled. So basically, preferred is going to get the first 50. If preferred does not get their full 50, then it goes into dividends and arrears. And the current year plus anything in dividends and arrears has to be paid before common can get anything. So if in year one they pay $20,000 in dividends, all of that would go to preferred, and what they didn't receive, in this case, they should have got 50, they only got 20, so 30,000 would go into dividends and arrears. Year two, the company paid 30, so all 30 of that would go to preferred, and they were supposed to get 50, they only got 30, so an additional 20 would go into dividends and arrears. So notice the balance is now 50 in dividends and arrears. Year three paid 40, all 40 will go to preferred. Preferred was supposed to get 50, they only got 40, so an additional 10,000, or now 60,000 is in dividends and arrears. Now, in year four, they pay 100,000. So in this case, what we would do is we would say, okay, all dividends and arrears have to be paid, plus the current year of what, 50,000. So basically, all that 100,000 is going to go to preferred, but it is going to reduce dividends and arrears down to 10,000. Because think about it this way: we took the 50,000 that was due to them in the current year. So there was $100,000 in dividends paid. So we took then the other 50,000 out of dividends and arrears. Now in year five, the company pays 150,000 in dividends, which would mean the current year 50,000 goes to preferred plus whatever's in dividends and arrears. So preferred would get 60, and the other 90 then would go to common. One thing to remember is that if it's cumulative, any year that preferred does not get their full dividends, that amount goes to dividends and arrears, and it'll sit there in dividends and arrears until all the current and dividends and arrears are cleared out, and then common can start getting some dividends. Now let's look at another example. Everything here is the same, except we're going to say it's non-cumulative. Non-cumulative just means preferred only gets preference in the current year, and that's all. There's no dividends and arrears with non-cumulative. Only in the current year do they get preference. So same example, everything we looked at before. Year one, 20,000 in dividends, all go to preferred. Year three, year two, 30,000, all go to preferred. Year four, 40, all goes to preferred. Year four, then preferred would get their 50, and then common would get the rest. Year five, preferred would get their 50, common would get the rest. This is a case of non-cumulative. Preferred only gets preference in the current year. There's no dividends and arrears to carry forward. Now, the last topic I wanted to talk about is treasury stock. And treasury stock is whenever a company buys back their own stock. And companies do this for various reasons. Sometimes they do it for executive bonuses and stock options, or management. Some companies offer stock options to managers at all levels. It just gets bigger the higher up you go in the company. Other times companies will buy it back if they feel like their stock is a bargain and they feel it's going to go up in value. They'll buy it back, sit on it, and then reissue it later. So companies do it for different reasons. So let's say that now one thing I did want to mention is treasury stock is a contra stockholders equity account. So you'll see it on the balance sheet at the bottom of the stockholders equity account with a balance, the debit balance, which is just the opposite of the normal balance for all the other stockholders equity accounts. So it is a contra stockholders equity account. So let's look at some journal entries. Let's say that we buy back 10,000 shares for $100,000. So basically, we would take the amount paid, the 100,000, divided by the 10,000 shares. So we would have paid $10 per share to buy it back. Our journal entry to record this would be that we would debit treasury stock for 100,000, and we would credit cash for 100,000. So now we've bought back some of our shares, and we're going to sit on them for a while. And then eventually we're probably going to reissue them. Now, so let's say we reissue 2,000 shares at $11 a share. So what we would do is we'd take 2,000 times 11. So we would debit cash for $22,000 to 2,000 times 11. We would credit Treasury Stock for, in all transactions to Treasury Stock are made at whatever price we paid to buy them back. So in this case, we paid $10 per share to buy them back. So we'd take that 2,000 shares times the $10. So we'd credit Treasury Stock for $20,000. And the difference between what we received for them and what we'd paid initially to buy them back for would be accounted for as paid in capital Treasury Stock, and that would be a credit in this case for $2,000. Now, why do we record all Treasury Stock transactions at whatever price we bought them back for? And the answer is simple. What we want to do here is we don't want to leave a balance in Treasury Stock. We only want there to be a balance in Treasury Stock if we own Treasury Stock. So whatever we repurchase it for, we take it out when we reissue it at that same price, to where anytime there's a balance in Treasury Stock, it's because we own Treasury Stock. If we didn't do it that way, then we could have a balance in Treasury Stock, but no Treasury Stock. So whatever we put it in there for, we take it out when we reissue it for at that same price. Now, what if we were to reissue 5,000 shares at $8 a share? Now, typically, companies will hold on to Treasury Stock. Typically, companies will hold on to Treasury Stock and won't reissue it unless it's gone up in value. Now, there are some exceptions to that rule, though, in that what if a company really needs cash? If a company maybe really needs cash, then they might be tempted to just issue some Treasury Stock, even though we're going to lose on it, just because they really need money, and that would be a good source to bring in some money. So let's say we reissue 5,000 shares at $8 a share. What we would do there is we would take 5,000 times 8, so we would debit cash for 40,000. We would then credit Treasury Stock 5,000 shares times $10 a share. We'd credit Treasury Stock for 50,000. Now notice there's a $10,000 difference between the cash that the company is bringing in and the credit to Treasury Stock. So the first thing the company would do is they would see, do we have any balance in the paid in capital Treasury Stock? So notice that from that first transaction, they've got a $2,000 balance in there. So in this case, they would debit paid in capital Treasury Stock to make up for some of the difference between what they bought it back for and the cash that they received. Now, once the paid in capital Treasury Stock account is used up, retained earnings would then have to be used to offset the difference. So you notice here that they would debit retained earnings because they used up whatever balance they had in paid in capital Treasury Stock account. So they had to go with retained earnings to basically balance out this account. So in this case, since they sold the stock for less than they bought it back for, retained earnings is having to eat the difference that wasn't accounted for as part of paid in capital Treasury Stock. So that is basically all I've got from this chapter in this area. It's a good area, and there's a lot of information in this area. So have a great day, and thanks for watching. Bye-bye.